The following is a presentation of TFNN. Live at TFNN, The Money Masters. Now, The Money Masters.
Welcome, folks, to the Money Masters Show. I'm your host, Steve Rhodes. Thanks so much for joining me, folks. We've got the Dow trading down 31 points right now. S&P's off 2. Composite down about 1.5 points. Russell 2000 only down 1.25 points. New York Stock Exchange off 22 points across the globe. Right now, the DAX in Germany off 17 points. The FTSE having a very strong session. Of course, everything had a strong session yesterday. The FTSE up 8 points right now. The Nikkei comes back online tonight, I should say. So the Nikkei has not traded here for the past couple of days, nor has the Shanghai. The Hang Seng last night up 86 points. That was up 0.37% out there. Our call-in number, 877-927-6648. Let's go take a look at these markets. Let's start by taking a look at the indexes, and we'll start off with the Russell 2000. Russell 2000 making the headlines in the news yesterday as it broke out over the September 14th highs. That's if you were paying attention to the actual index versus the ETF, the IWM out there. But let's start with first things first. Let's take a look at the Russell 2000 here. The high out there on the Russell is the high was 868.50 from September the 14th. You can see crossing through that with wide price spread, accelerated volume. Now, if you look at the bottom of the chart here, this is the daily chart that we're looking at. You can see that the Russell 2000 getting up into that overbought territory, utilizing that relative strength indicator. That says that the Russell 2000 should start to begin moving sideways or pull back. Last time that was up in this area, it got up here on the 18th and 19th of December. I went ahead and traded sideways here for a couple trading sessions before it traded lower. I suspect what we will see is we'll see it trade, sideways to lower today and see a pullback tomorrow coming into Jobs Friday. That is the most likely outcome out here. Now, it does have a confirmed A to B equals CD up, and we're going to have to shorten the charts up here on the screen here. The 1-to-1 A to B equals CD up takes you to 916. Reality, though, is right around 940 is where this would end up moving to. That would be setting up a butterfly pattern. We take a look at what that butterfly pattern, first let's just take a look at, because some of you don't have that tool, so I'll just simply show you how to actually draw that pattern. What you would be looking at is the swing point high from September 14th. Again, that level, 868.50, all the way down to the low that came in on November 16th. What you'll see, at least you'll see if you use the 1.272 and 1.618 expansions on your Fibonacci expansion and retracement tool, and those are the numbers that you want to use. You can also use 2.618. What you'll see is the 1.272 expansion. I don't know why the numbers are not on my screen. There we go. All you have to do is just ask. It is below the 1-to-1 A to B equals CD. I don't think that is where it will stop at. Instead, what I believe in the more likely outcome should the markets continue to move higher. There's some divergences in the markets that we have to absolutely pay attention to. But right now, as we take a look at the charts today, as we take a look at the two wide-ranging bars, as we take a look at crossing a B point with volume out here, what this is suggesting is that price would move up into the 933 to 941. That sets up your A to B equals CD, and it sets up your Gartley sell pattern. So I'll go ahead and draw the pattern in here. I'll have to do that here in just a moment, so you can see what that expansion butterfly sell pattern here actually looks like visually. This is what it would look like. At least that's what it looks like to me at the moment until we get any additional information. So big moves out here, but the Russell is the one that is up in the overbought territory first. So expect that to maybe as the others catch up, either trade sideways, pull back, or what have you. But it looks like this is the index where you would want to be long after the next retracement. What would that look like on a daily chart? Well, if you get a decent enough retracement out here, it would come back to about the midpoint, to about the 50% level on the relative strength indicator out there. Now let's go take a look at the actual ETF. Some of you don't have the actual index. Let me just refresh my chart here. Make sure I've got all active data. You can see yesterday having wide price spread out here. Volume-wise was 116 million shares coming into September 14th with only 46 million shares. Excuse me, I'm going to sneeze. Okay, I guess I'm not, but I might end up sneezing, and if I do, I'll apologize. I have one of those little dust balls or something that ran into my nose. So when we take a look at A to B, here's the B point on the IWM. That happens to be the December 18th level. Now, first thing, let me point this out to you on the IWM. So unlike the actual Russell 2000, and the reason why there's a difference between the Russell 2000 index and the IWM is the IWM, the ETFs are accounting for all types of dividends. So it is adjusting prices out there. So that's why, you have a difference when you take a look at the actual indexes versus the ETFs out here. When we take a look at the IWM, what I want you to really note is that the high of September 14th is 86.96. Yesterday, it got up to a high of 86.91, 5 pennies. 5 pennies shy. Today, it has gotten up to 86.88, so it has not taken that out. And from a bullish standpoint, quite frankly, it stopped just before it. So now what it can actually do as it's gotten into the overbought territory, and it hasn't taken on that swing point, but it's come up there with accelerated volume, that could be a very bullish sign out there. So your preference is, quite frankly, after the last two moves, for the IWM to actually go ahead and pull back. Now, it did confirm an A to B equals CD by passing that B point, blowing past the B point, which is your December 18th level, that at 52 million shares. So if we take a look at just A to B equals CD, and when I draw an A to B equals CD pattern, folks, I'm using a 1-to-1, a 1-to-1.272, 1-to-1.618. Some people use 1-to-1.382. Just use whatever works for you, and 1.618 level. Well, on the Russell 2000 index itself, we were taking a look at the 1-to-1.618 expansion. That says 93.04 is most likely the target area for the IWM. It's traded at 86.71. Don't jump in right now because there's some divergence out here. I believe the market will pull back. And let's go up to British Columbia and talk to our man, Rick. Rick, thanks for calling. Thanks for holding.
Hey, thanks for taking the call.
Hey, folks, before you start, Rick, first, I want folks, if you didn't listen, Rick is a great trader out here, and he's called with a couple of real pearls. One of the pearls was he was taking a look at Microsoft on Christmas Eve, on New Year's Eve, December 31st. And this one I want to show you is here's a gap, and what I want you to do is I want you to pay attention to gaps because gaps can absolutely be your friends here. And if we take a look at Microsoft, what Rick was looking at was January 3rd. The low of that gap was 26.39, 64 million shares. You can see that window, that gap has been tested several times, back in November, back in December, and then again on December 31st on lighter volume, gapped up yesterday. Now, what it also is doing, gaps are your friends. They also tell you where you've got resistance. In this case here, what Microsoft did was ran right into the top of the resistance area. That's the gap down, in essence, that is out there from November 23rd. So anyways, Rick, I wanted to thank you for that and passing on that trade to all of our listeners out there.
Well, what I like to do a lot of times, I watched yesterday's gap up.
Yes.
And I put it on a 15-minute, and I think that gap's going to get filled again.
Well, yeah.
Because
I think it will get filled. I think it will get filled. Go ahead.
Yeah, no, and another one I mentioned was CLNE, but I'm not always the best at picking them. CLNE, I mentioned, we talked about that one
absolutely
at the same time.
Yes.
And I mentioned that down at what was it, 12 area or something like that?
Yeah, you were looking at the $12.
Yep. Long term, that one to me, Boone Pickens.
Yeah.
He apparently has lots of it, and now, whether that means something or not is, take it for what it's worth. But
no question.
This thing looks like it's got volume sitting up there it kind of has an inverted head and shoulder on a weekly or a daily if you look.
Yeah, I see it, yeah.
And that would target 18, and basically they're getting into natural gas stations and stuff like that.
Right.
From a fundamental point of view. So, but anyways,
so you're looking at Amgen?
Yeah, I'm looking at Amgen and I'm looking at the U.S. dollar.
Okay.
So let's take a look at Amgen first. And I think the dollar's going a little higher here, which I think you're right. I think we could pull back here a little bit.
Yes.
But Amgen, I shorted it this morning.
Okay.
At I think it was 89.47.
Okay, well that's nice. Trade at 89.16 right now.
Yeah, and I looked on a daily, and it broke the 88 mark on lighter volume.
Yeah.
So I just put my buyback in at about 88.13. I always like to set a little bit above it. You know what I'm saying?
Yes, absolutely.
But this one really doesn't look that good on a bigger scale. What do you think?
Well, so if you take a look at there's been no sign of institutional selling in this equity here. And it's just kind of gravitated to the highs with just kind of some normal volume, so not really any breakout volume. I guess the first, if there's a sign of institutional selling, it's probably the day of December 21st. So I think that's what you're looking at when that moved down with 7.2 million shares and moved up yesterday with 5.7 million shares out here. And if we take a look at the longer-term chart, let's take a look at the monthly chart out here.
It doesn't look that good on a let's say a 3-year monthly, or you don't even need to go 3 years. But anyways, you see the last, just I don't know, the volume just doesn't seem to be there. You know what I'm saying? Like this thing could pull back to the breakout at 73. Really it could pull back to 65. Yeah,
on the monthly chart, what I would do, my first blush is to try to identify where there's some support and resistance. And so when I take a look at the area that used to be resistance, I would say it would have been the high of 2000, July 31st, 2000, right in that $80.44 level. And when the equity tried to get back up in there in 2005, late to early 2006, that really acted as a very nice area of resistance. But what happened is, you came through that area with a wide-ranging bar July of 2012. And when you get above an area of resistance, it then becomes support. And what happened on the preceding or the succeeding 2 months, August and September of 2012, you can see how Amgen tried to pull back in there and rejected that area. Now, you had a bearish engulfing candle last month, December. However, so far, that bearish engulfing candle hasn't confirmed. So I take a look at the longer-term chart. Forget about the volume aspect of it.
Yeah, you have to forget the volume.
Yeah, so I'm just, kind of just looking at just natural lines of support and resistance and what the bulls and the bears are telling us with regard to signs out here. And it hasn't broken out with volume, but it did break out above a resistance area. And so support now ends up really being the $80.44 level. Out there on the monthly charts. That's what the monthly.
Do you ever put it on a yearly for something to do? I put a 10-year yearly, and I mean last year it went up on absolute fumes.
I do look at yearly charts. The system that I have here, this package that I use on air, doesn't allow me to use a yearly time frame. Well, I could actually rig it so that
or even quarterly.
So
I don't know.
Yeah, I've got to work with some different time frames in order to do that. But I do it. There's another charting package that I use, and I take a look at yearly candles fairly often out there.
Yeah, and Steve, it looks to me like the dollar's going to rally to 81. I'd like you to look at the dollar later if you could.
Yeah, I will absolutely. Have a great day, Rick. Dow is off 36. S&P's off 2. 877-927-6648. We'll be right back.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage of TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
Welcome back, folks. Dow's off 32 points right now. You got Priceline leading things up $18 and change. Google up $5. Ralph Lauren up $4. MasterCard up $3. Ross Stores up $3. Fossil up about 3 points. Weight Watchers putting some weight on, up about 5% this morning, up 240. Leading things to the downside, Melanex Technologies off 17%. Family Dollar Stores down 11%, off $7. Biogen off 4%, down $5. A Lot Communications down 21%. We'll take a look at that equity for sure. Limited Brands down 3. Stage Stores off about 10% this morning. And we're going to start off, though, taking a look at the some currency pairs out here. The first one we're looking at is the Queen, the Euro US dollar. We can see here that is trading lower this morning. The Euro making a high, coming into an area where it was testing a previous swing point. That swing point it was testing was May 1st, 2012. Now, as it was testing that May 1st, 2012, it gave you really the first sign that it was tired of the, when I say tired, it was exhausted. The move up, it came into a support. It came in there with a doji candle here, gravestone doji candle on December the 19th. And dojis have much more meaning when you come into resistance areas. It was doing that. It was also doing that while it was getting into the oversold condition of the relative strength indicator out there. Overbought condition, I should say. My apologies. Sometimes I'm thinking one thing and I'm saying another. So just slap me on my head and I'll say the right thing. I promise. So you can see here it was giving you signs that it was tired, that it needed to work off the overbought condition. You got little high wave candle out here on December the 20th. That's also an indication that it was losing its way to the upside. You got a bearish engulfing on December 21st. You can see it's really hung out here, moved sideways. Now, as it had been moving sideways all the way up through yesterday, what you can see that it was doing was working off the overbought condition. Now we're seeing a little move lower. I suspect that what we will see here is we'll see this move down to somewhere around the 0.618 retracement of the last move up. We'll go take a look at that. If you take, why do I say the 0.618 retracement? Well, patterns repeat. Just like, the market has rituals, just like you have rituals each and every day. Probably when you put your pants on, assuming that you put pants on, even a set of jeans, you probably put a certain leg in your pants, each, in order. Some people use the left leg, some it's the right leg out there. So patterns are out there, rituals are out there. If we take a look at patterns here, the first pattern we'll take a look at is the move off of the lows here when it was in oversold condition. You can see how price was. You got doji candles down at the bottom on November 13th, getting into the oversold territory. That low was around 1.26593. Makes a move up. When it makes a move up, where does it get up to in the RSI? Makes a move up to the overbought condition. Does that, completes that on December the 5th out here as it was testing an area of resistance, which was really the last swing point from October 17th. Then starts to move over to work that off, and as it moves lower, it only gets to that 50% level. So that says today's trading in the euro is going to be key to watch out here, because if it only gets into that halfway level, then it's saying that in essence the low of today, or maybe a little bit lower, could end up being the end of the move down out here. If we see it start to break that level, what you will see is you'll see it make a bottom just like it did back in November as it were to move down. Now, you can see that the retracement of that first move from November 13th to the high on December the 5th out here, just shy of a 0.618 retracement level. So it sets up, the odds are, I think that's a little bit more than 50%. So between 50 and 61% out there as it made a low coming into December 7th. That says that what we're likely going to experience here, or it'll give you a lot of information, is take a look at the way that it's trading now. So it's giving you some bearish signals, most certainly, and you can see it's below the 0.382 level. It's almost at probably about the same level that it actually hit on that first go-round. The first one, say the first go-round, again, from the November 13th low to the December 5th high. So right now it's pulled back to approximately the same area. Now, 0.618 is not that much lower. 134 area, you can see it is also at about that halfway point out here. And if this is all that we see in a pullback in the euro, and this begins its next A to B equals CD up pattern here, you'll see some real energy coming into the markets. What do I suspect? I suspect we'll see the euro this time pull all the way back down into the 0.618 level, maybe a little bit lower, but we'll probably see here as we will see the relative strength indicator get down to the bottom of that. Tomorrow is the most likely day for that to occur as it's Jobs Friday out there. And the Jobs Friday has a high probability of being a day where the market closes lower. Market closes lower, the euro should close lower. That is on the daily chart of the euro. When we get back from this break, we'll go take a look at the Japanese yen, because that is also key to the U.S. dollar index. Right now, you've got King Dollar trading out at $80.25. So the euro pulling back, that's putting some strength in the dollar. 877-927-6648. We'll be right back.
You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at Nadex.com. That's Nadex.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Welcome back, folks. Dow off 19, S&P about flat here, off 50 cents. Composite up 56. Small caps up 45 cents out there. It's not what you actually want to see from a bullish standpoint. Right now, and it's because of some divergences that are in the marketplace that have led to larger corrections. So one of the worst things that you could see right now is for those correlations to continue and exist out there. So we'll go take a look at those in a minute. But we'll come back to the euro here real quickly. I want to show you this is just the 30-minute chart that we've got up on the screen here. We're going to take a look at A to B equals CD patterns on the way down off of the highs. So if we come back, we take a look at trading in the euro on January 2nd. You can see that the euro had gapped up and made a high out here at about 3 o'clock in the morning out at the 132.919 level. So your first A to B equals CD down. You start your 8-point would be the top of that candle on the 30-minute chart. I'm using as the low. Looks like it is the 6:30 a.m. time frame candle. Makes a retracement. Looks like probably about a 0.786 retracement on the way back to about 8 o'clock in the morning. And then boom, starts to make an A to B equals CD. Now, as it makes the 1-to-1 level, you've got a wide-ranging bar on the way down. In fact, so wide-ranging that not only did it get to the 1-to-1 level in that 30-minute, not only did it pass the 1 to 1.272 level, but ran all the way down into the 1 to 1.618 A to B equals CD. In fact, looks like it hit it Johnny on the spot out there. As it was moving down to that level, no bulls showed up in that first 30 minutes. You did get this little candle out here that suggested that things were going to stall a bit, but you can see it really still had not reached the oversold condition. It went ahead and decided to do that on the very next candle when it makes a 1 to 2 A to B equals CD. Now, if you've got Tom's book, The Art of Timing the Trade out there, you know that that when a market makes a 1 to 2 A to B equals CD, it is typically a reversal. So that's what you should have been looking for. That's what the euro on a 30-minute chart should have been doing. Plus, it got down into that oversold territory. That's the RSI if you're watching the bottom of the screen out here. Now, as it moves down there, what you see is you really don't see any bullish candles out here. Now, what I'm going to first do is I'm going to go ahead and get rid of the A to B equals CD. Makes it a little bit easier for you to be paying attention to. We're going to be focused on this candle right here at 12:30 yesterday afternoon. It's this candle. In fact, I'm going to go ahead and mark it with some lines. It's going to make it a little bit easier out here. So we'll put a black line across both the top and the bottom out here. Now, as soon as I can get the line tool out here, and we're going to do it across. We're going to do it across the body. So I'm going to do it across the body of that actual candle. The body is really the essence of price out there. The wicks, the shadows are important. That's the little low-high sticks out here. But it's really the body is the essence of price. Now, as you can see, as price moves down on the 30-minute chart out here, I'm going to teach you something. I always promise to teach you something. I always like you to write down, I want you to learn one thing each day of the year, 365 days of the year, and I want you to note what you write down because I want you to go back and take a look at those, actually journal it or what have you. If you want to improve your trading or just simply improve your life, and you want, those are the things that you really should do. So coming back to that candle from 12:30 here, what I want you to notice now, there's a candle, a Japanese candlestick pattern called rising 3 and falling 3. This one doesn't meet the criteria. However, it meets Steve's criteria of watching the price. And a rising 3 or a falling 3 is a continuation pattern. There are not many most candlesticks are reversal signals out here. I'm not going to teach about the falling 3 or rising 3, but I'll teach you about something that you can be paying attention to that does also work from a continuation move standpoint and helps you to understand weakness or strength inside the marketplace. So if you take a look at this candle, we know it made a 1 to 2, A to B equals CD. Should have been an automatic reversal, and certainly that held it in check here. Market goes ahead and moves sideways, so we know when it's doing that, it's working off a condition. This case here happened to be oversold, but price never got above the top of that candle at 12:30. Never got above, but you did get a break right here. So if you're trading currencies, you're still in the trade because you're waiting for the reversal signal. Let's say you happen to catch it at the top, or you caught it at the retracement here, probably the 618 or 786 retracement, 8 o'clock in the morning out there. But you're still inside this trade. What you don't want to do, there's no reason yet for you to exit because you want to see it get above that candle. You also know you want to see what's going on inside relative weakness, we're going to call this, not necessarily relative strength, because it's trading below that midpoint, that 50% level out here. As soon as you got this close right here, this close at 8:30 in the evening last night, January 2nd, it closes at 1.31634 out there. That was giving you a signal because you closed below that body right here that gave you the 1 to 2, and you started moving back into where it was no longer oversold out there. You had worked some of that off. That was your indication that this thing wanted to travel lower, that it was going to go ahead and start a new A to B equals CD down pattern, or at least it was going to go ahead and be a continuation. And most certainly that's what you saw happen at 10 o'clock last evening as it moves down. Now it moves down. Let's go take a look at this multiple times, okay? So you've seen the first one. Now let's go take a look and see it again. Let's go watch the patterns repeat themselves. Candlesticks, folks, I'm telling you, they are communicating to you more information than you have any idea, and you want to learn it. You absolutely, I don't care what level of trading that you are at, this is the language of the markets, and you should always know what the markets are communicating to you. So let's now go take a look at it. Here's the candle that boom goes down at the 10 o'clock time frame, gets into the oversold condition. When you get an oversold, what are you going to do? You're going to work yourself off. What does this thing do? It works itself off by moving back up, getting to that midpoint, right? Gets to about that 50% level, which doesn't take out the entire body of that candle at 10 o'clock. And boom, what's it do? Once it gets closes below that, another continuation to the downside. Going ahead and making it looks like an A to B. Let's go take a look at that A to B equals CD. This is the new one that is out here. So let's go see what the euro is doing. And now having this morning gone ahead and completed the 1 to 1.2 A to B equals CD. Now, it works all the time, folks. So now we're going to go take a look at this candle I would say we would look at this body right here as it completed that 1 to 2, A to B equals CD, and that's going to be, we're just going to draw the lines right across here. You can see so far the euro has not penetrated that area, and you can use this whether you trade the Nadex platform, you actually trade the currency pairs out here, but the candlesticks and the body is truly the essence of price. So you're going to use just the body of the candle. You're not going to use the wicks or anything out here. This is a smaller body, so it should have no problem if the euro is going to go ahead and bounce from here after having made a 1 to 1.272 A to B equals CD down. So this is how you go from a larger term time frame. We were at the daily chart, and then we went ahead and we drilled down into the 30-minute chart to look for chart patterns that are out here. So right now, if you see a close below the level of 1.3119, that says the euro wants to move lower. If we take a look at relative strength or relative weakness out here, you can see it's working that digestive pattern off, working its way back up to about that midpoint level. Doesn't necessarily have to even get all the way up there. Now, if it closes above the candle here, that is the 7:30 a.m. candle, 1.31123. That pattern is no longer there. But let the people talk about the trend is your friend. The candles, folks, are your best friend out there. If you'd like to learn how to trade the candlesticks or understand candlesticks, just go to my homepage, go to Steve Rhodes on the homepage of TFNN.com, and you'll see a workshop that is out there that is worth more money than gold. So you want to be able to use this stuff in your trading out here. Now, divergence, we were talking about, I mentioned divergence out here, that probably one of the worst things to happen today would be for the markets to continue to move higher. That is not a good bull sign. You want to see it actually move lower because of divergence out here. Now, I'm going to share with you, I mentioned this in the early hour, the first hour of the opening show. We're taking a look at divergent patterns that are out here. One that I shared with you, this is one you want to make sure that you also have in your trading arsenal. This is the actual currency pair that really tracks the U.S. market is the, how did I do that? Let me pull that back up. Sorry. Is the euro Japanese yen currency pair out there. That's what I've got up on my screen here. That's the bottom of the, let me move this down just a tad here. We come in here. There we go. And as we take a look at it, so it's the euro Japanese yen currency pair that has a better correlation to the S&P 500 than any other any other currency pair that is out there. Now, what this is really good for is also identifying divergence. You want to be able to identify divergence in any marketplace because it helps you to understand likely what is going to come. And when it does come, when you see a candle signal, that will help you to be able to pull the trigger. Now, you can take your chart back. This is a daily chart. You can take this back as far as you want, and you will find all kinds of examples of this. This happens here to be, let me see if the time frame, let me just move the chart up just a tad. And if you're not watching us on Tiger TV, do yourself a favor. Go to the homepage of TFNN on Tiger TV and catch the archive of this show on channel 10, and then you'll be able to actually see it on my screen. So you may not trade currencies out there, but most charting systems will give you free data feeds for currency pairs out there, or you can find systems that will do that. So even though you don't trade them, they are one of the best tools because it's really currency rules. And I mean that because it's such a larger market. You know, like, I don't know what the number is, 10, 40 times the size of the stock market, 100 times the size, hugely different than the U.S. stock market. So it is the currencies that rule, so you want to understand when there's divergent patterns out here. If you take a look at the top chart here is the actual S&P 500. The bottom chart is the euro Japanese yen. Take a look at here. We're in a time frame here, goes back to May. It looks like it might be May of, let's see, is this 2011? Looks like it might be May of 2011. Look at that time frame, how you've got the market making a high. That's the black line going up, and you have the euro Japanese yen making a low out there. That was giving you a sign that you were going to see a retracement in the marketplace. You're going to talk about sell in May, go away, and take a look at when you have a divergent pattern here that gives you confirmation. How would you like to be able to trade with that in your hip pocket? Take a look at the next time. You're taking a look at the July area here. You've got the take a look. You do have the S&P moving down, but take a look at the steep angle of the currency pair moving down. And what do we end up with? We end up with a real waterfall move down. This was into the August 2011 lows out here. Take a look at as the you've got this accelerated move up in the S&P 500 as was making that first move up here, and take a look at the euro Japanese yen. Just a slight move up there was giving you a signal that things are not necessarily so rosy. But if you take a look at this chart here, this is what I include in. So this is one of the tools that I include inside my newsletter service out there. So you've got divergence there. There's also divergence between General Electric and the Dow out here. I'll go ahead and pull that up on the screen for you. These are indicators that, quite frankly, nobody, well, I won't say nobody, but very few people actually teach out here. And these are ones that you want to be paying attention to because they end up leading to the larger moves to the downside. General Electric is I don't know, it's number 27 or 28. Maybe inside the Dow 30. It's only got a little over 1% weighting structure inside there, so it's not going to lead the Dow up or lead the Dow down. But what it is, it's a leading indicator for when you're going to see a market correction. In this case here, the Dow, GE, the General, as you can see, that's the red line at the top, has been moving down, whereas in the same time frame, you have the Dow actually having been moving up out there. So you've got some divergence in the marketplace out there. If you want to take a look at these and other tools, you've got, in fact, I'll do one more thing for you inside my newsletter. Now, the newsletter itself is like about 40 or 50 pages each day, covering all markets, giving you all kinds of information out here. If you want to know the number one, would you like to know, I don't remember if I told you this or not, the number one leading indicator for reversals in the markets last year, at a 100% rating of identifying turns. It wasn't a lunar, it wasn't a full moon, it wasn't a new moon out there, it wasn't apogee or perigee. It was another. Let me find it out here, and I'll actually show it to you. 1 second, where is it? There we go. It's the Venus-Uranus cycle out here. Now this is the chart for all of 2012. Now I've redacted what's included in the chart are all of the other Venus-Uranus major aspects that you want to be paying attention to in 2013. But this is 2012, all of 2012's cycles out here. And each time, the first one was in April of 2012, and that marked the bottom. The market was moving down or marked a low out there. The market was moving down. You saw a reversal here. The next time that the cycle came in was June 21st, 2012. Market was moving up into it. That identified the high out there. Then the market, this was coming off of the June 4th lows. Then if you take a look at July 5th out here, you've got the market moving back up into that area. In fact, we're kind of in a similar pattern here right now. Now we don't have this cycle, this astro cycle that's out there, but it did pick a high. Take a look at August the 16th out here. Actually picked a high, market moved down. Just now you got to use normal retracement levels or other candlestick patterns in order to be able to identify when a move is over. How about the September 13th time frame? Went ahead and picked out the high in the marketplace in the S&P 500. We just simply continue moving forward over here. November the 1st, 2012 identifies a market high, and then most recently here, December 19th. Now that was taken out, obviously, but you did have the move down into the December 30th time frame out here. The number one, and there's others that are included inside here. If you're looking for a wealth of education, it's not just about telling you what to do, which I do that up at the front. So for those folks, and there's so much in here that what I do for folks is there's charts on almost every single page, and when I go ahead and I've got a change to something, I'll go ahead and put it in red versus something that might be in black and red. So you just know when something has actually changed inside a chart. Here's silver, for example. In fact, when we come back from break, we'll go take a look at silver and that same technique when we were taking a look at the body of the candle and where price has traveled to. Because we're going to see the same pattern when it comes to silver out there. 877-927-6648. We come back, it'll be Hi-Ho Silver. Be right back.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try patterns, profits, and peace of mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's patterns, profits, and peace of mind and get the edge you've been looking for.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to tfnn.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of tfnn.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
Welcome back, folks. One of the equities here struggling today is Allot Communications. ALLT is the ticker symbol. They engage in developing, selling, marketing, internet protocol, service optimization, and revenue generation solutions in Europe, Middle East, Africa, the Americas, Asia, and Oceania. How about that for being out there in the marketplace? Now, we'll take a look at this stock chart. One of the things you want to do on any stock chart that you trade, and first I want to do is I'm going to move this, if you're watching us on Tiger TV, I'll move this off to the left here. And as it was making its highs, you want to make sure that you're always aware of where the high volume bar is, typically a high volume low out here. In this case, what we're taking a look at, because that really becomes your area of support. If you've ever asked yourself, when something falls out of bed, where is it going to fall down to? It's going to fall down to the floor, right? If you happen to have a bad night, well, the floor, in essence, in a stock chart ends up being that high volume day, the high volume bar. In this case here, it's November 9th, 2011, does 4.1 million shares. That price point is 1445 to 1550. Now, if we take a look at where it's trading right now today, it's 1432. Of course, today it's got quite a bit of volume. But if you take a look at this equity here, as it was trading, it's got some real nice patterns out here for me to share with you if you're watching on Tiger TV. So I'm going to pull this off to the right here. The 8-point happens to be the low that came in on October the 3rd. That was a low of $9.38. So from that moving, it was nice when you see this volume come in here. Didn't have wide price spread on November 9th, but it was a nice little signal here that you had some friends along for the ride. You wanted to be able to draft those friends. We talk about waiting for an equity to pull back to an area where it broke out. Certainly that was some breakout volume on this equity. And what it did was it was making the B to C leg down, which was on December 23rd out there, was pulling back with 1.3 million shares, got down to a low of 1455. Now that A to B equals CD out here, if we take a look first at the retracement, that B to C leg, so go from A to B right here, and you'll see it was a 0.382 retracement. What does that tell you? It tells you you're going to do more than a 1-to-1 A to B equals CD. And when it crosses the B point, which again is December the 13th, the level is 1888, 460,000 shares. It does it with accelerated volume and wide price spread. Exactly everything that the art of timing the trade teaches you out there. So it gives you the confirmation, says it wants to move up to the 1 to 1.272 level at least. That's what it does. It does that by gapping up into that level in May 2012. Now what it also set up at the top was a resistance zone at the highs that were made here in June of 2012. Gives you this little reversal signal right here on the day of September 10th. Gives you a shooting star candle. Get a little bit of follow through on the, you really get the follow through on this thing on September 17th and the 18th out here. Now what it has done, it has fallen out of bed big time. You saw some dumping of shares, some institutional unloading on December the 14th with about 3 million shares, 3.5 million shares to the downside. And now today, so far, it's only been trading for, an hour and 20 minutes or so, already 3.6 million shares. And what it's trading right into? It's trading right into those guys, trading right into that high volume bar. If this area does not hold, which it has not held thus far, it says that this is going to come all the way back to the $9.38. That's after taking a ride on the Reading Railroad up into the $29 level. So from 29 to 9, that is a haircut out there. Let's quickly switch over here to silver before we go to our man Basil Chapman, and we go take a look at the silver contract. What I want to point out to you is that same body, which is on December 20th. So far, silver has not been able to break that to the upside, nor to the downside up here. And if we take a look at the relative weakness, that relative strength indicator hasn't even made it to the midpoint out here. If silver can break the body of that candle, then what I was showing you on the euro, all bets are off there. That pattern no longer exists. Otherwise, be careful out there. Stay tuned. We got Basil Chapman coming up next, Larry Pesavento, Daryl Martin, David White from 2 to 3, Ken Shreve 3 to 4, and the Tom O'Brien Show from 4 to 6. Have a great day, folks. Look forward to seeing you in the morning. Take care.